Hello, my name is Tim Krause, and today we're going to be going over a real acquisition workflow for accounting firm owners. Actually, this is my first accounting firm deal that I ever purchased was actually with this very paperwork we're going to go over today. I've anonymized it because I want to make sure that everyone is kept safe as far as that goes. So we're going to go over this here. Now, this was an asset purchase agreement, which means that I purchased the actual client list. And as you see, this also had a seller note as well added into it. So let's get right into it. So a little bit of the story of this one. So this was my very first accounting firm I ever bought. Actually, I was new into the accounting space. This was purchased back in August. I joined in 2023. I joined the accounting space in February of 2023. So this was my very first one ever. And this did currently at the time double the amount of bookkeeping clients we had on a monthly basis, which was a big stressor to the company and a big learning curve for all of us there. So that was something that was a lot of work. I'll say that much. So, and one of the things I did learn is that during that time, there was kind of an overview, one influential client who left immediately. We had one conversation with this gentleman, and then they just didn't, we never even got access to their stuff. They never gave us a thing there, which actually ended up triggering the retention clause, which we'll go over more detail here. So we only ended up making it on the seller finance note. We only made one payment at the very end of the day because that client was had quite a few other clients with them or other entities with them because it's in the real estate space. Overall, though, with the additional services we offered and with the retention that we did have, still I would consider this a successful acquisition. Some good disclaimers here. I'm Tim. I'm the operations partner for Krause Accounting Group. We have a couple different locations. We did a little over 1.5 million last year in revenue. We got a team of 15 plus, part-time and full-time, and we are in the market for helping accounting firm owners who want to buy, but also for buying accounting firms actively. So if you have an accounting firm over $500,000 revenue in the state of Washington or over $1 million revenue outside of the state of Washington, please reach out. Let's talk. So, with all of that being said, I never said in that little disclaimer that I'm a lawyer. This is not legal or tax advice, and I've removed that information there, including the dollar amounts. We'll talk about the percentages and the ratios and the general idea, but we don't need to get into actually the dollars and cents of it all. So we're going to be doing, again, the structure, the ratios, all the lessons that I learned here. So first off, how did we meet this seller? This was not a broker deal. We actually used the same project management system. We were both using Carbon at the time and a sales rep from Carbon. We actually had the same sales rep, and they actually introduced us. And we both came from real estate. I was literally just finishing up my land business at the time, and actually he did also land investing as well. So it worked out that we actually had a few calls together, built a little relationship because we were both able to talk about real estate systems, marketing, and then also accounting, which is kind of not always the combination there. Actually, it's funny, my most recent acquisition, which was the bolt-on acquisition, the owner of that one had the history like 30 years ago of being in real estate as well. So maybe there's something there. So we talked several times over several months. We did not start the conversation with me wanting to buy his firm. We started the conversation with, let's just talk about real estate and accounting. And then after a few months, I was like, hey man, I'm considering buying a firm. And then he was like, really? I'm considering selling my little firm here. So we went into kind of how this will look, and he really wanted to have a good transition for his clients at the end of the day. That was his biggest goal. He had 2 part-time staff, or one that was basically out the door, and then another one that we actually paid a small severance to. But those weren't really the main drivers in the business. It was mainly him and his girlfriend at the time. So why they sold? A lot of people sell for retirement, health issues. They want to move on. They want to just move on to something else. This was wanting to move on to something else. They were in their mid to late 20s. They've been in business for, I believe, 3 or 4 years at the time, and they had a remote small team, and they did not like all the people management that accounting firms have. Yes, accounting firms have a ton of people management. It is very labor intensive, and you have to have a system and a process for training those people, building them up, and to be honest, the main owner, he was really good at selling accounting firms, or accounting services, especially to real estate professionals. But they didn't have quite the systems or the structure to be able to actually fulfill consistently, and especially with how much he was able to have them grow. So, and also he wanted to get back into real estate, which is great. So we were able to work this out for him. So like I said before, we bought this under what's called an asset sale. There's an asset sale and a stock sale. With an asset sale, you buy the assets of the company, which is basically like if it had inventory, all the inventory. But in this case, it's going to be mainly the client list. We're buying basically a very warm introduction, and the previous provider saying that they're not going to work with them anymore and they have to come work with us, or should come work with us. Because again, when you're buying an accounting firm, you're buying the habits of the clients. Like the clients, unless you have some sort of really long contracts with zero of my firms that I've worked with, and we don't either have contracts to lock people in for years. Accounting is very much a relationship business. So this is basically just a really warm introduction to us, and also, hey, we're stepping out and here's a really good place for you to go. You should go there. So their brand went away. In a tuck-in, only one brand remains at the end of the day, and we acquired the client list, essentially. Also said this earlier, no staff came over, and the girlfriend did most of the actual day-to-day accounting work. And then so both of us agreed it wasn't worth transferring the staff in this particular deal. So what we're going to break down next here is we're about to get into the paperwork. We're going to go into the asset structure, the seller note, the retention and holdbacks, which is something for risk mitigation for a buyer of an accounting firm, because you do not know what's going to happen. Those sort of retention clauses are very, very important, because you're putting up a lot of money, or you're investing a lot of money, or owing a lot of money through seller financing, and you don't know if it's all going to work out in the end. I mean, I've heard of a story, this is not my story, but I've heard of a story where a firm had been sold multiple times, which is not a good sign. But it had been sold, so you have this firm here, it had been sold a couple of times here. So, and there was non-competes and NDAs in between these here, in between the firm owners here. But now that this third guy had bought the firm, there was no NDA for the first person here to go after the firm's clients. And they did in this case, which was not good. Again, not my situation, but that definitely can happen. That's where those retention clauses, because if seller number 3 here would have a retention clause with seller number 2, that would encourage seller number 2 to get after basically firm owner number 1 in this little red scenario here to stop doing what they were doing, if they legally can. Again, that's not how I prefer to do deals. I prefer to have them very relationship heavy. So the paperwork walkthrough. So long story short, on the paperwork here, we're not gonna dive into every single detail. I'm not showing every single page. I'm showing all the important pages. There are a lot of very long pages. We worked this with through a lawyer. One thing I learned, big lesson for me in this one, was making sure I should have had all the details basically pounded out with me and the seller before talking to the lawyer at all. Because I went and talked to the lawyer. He did his first pass. It was not what I thought that I told him at all, but it was just talking to him, wasn't written down. And then he did another pass, and it got expensive. It wasn't tens of thousands of dollars at the end. I think it was $3,000 or $4,000 in lawyer fees roughly at the very end of it all, but it could have been a lot better. I'll say that much. So we're going to read these docs, not from a lawyer's mindset, but from an operator's mindset. I'm also not going to talk about the tax implications, because, to be frank, that is my partner, who's a CPA. She does all those sort of pieces here. We're just going to go over kind of what are some things that if you're looking at selling your firm, or if you're looking at buying a firm, you should potentially consider and have inside of a contract, and how it affects the whole arrangement there. So, fun side note, I haven't looked through these paperwork. We bought this real estate. We bought this business in August of 2023. It is now January of 2026. I haven't looked at this paperwork since basically September or October of 2023. And one funny side note is this thing starts on page 4. That is not a typo. There's actually no page 3. And page 1 or 2 are starting pages. There's actually no page 3 in this whole thing. But that's just a fun thing for me. So there's a couple things that are in this deal here where it is going to have a promissory note, which is a seller finance note, which means that I'm promising, or in this case also, for some reason, my partner Miriam signed all the contract. Now, she was 51% owner at the time, and I was 49% owner at the time, so we think that's why. To be honest, again, neither of us remembered that she was the only one who signed. Just completely forgot about that. So a seller note with an interest rate, and basically having it amortized over 2 years, paid monthly, also with a balloon balance due after the first year. So even though, let's say we have a note of, let's say I owed him $50,000. Okay, 50K. If it was amortized over the 2 years, we're not going to run the interest rate because I really don't want to. That'd be $25K a year. Okay, but after that first year, because of the balloon here, a balloon payment means it's due all at once. So after that first year, I would pay him down to $25,000, and then I would owe that $25,000 all at once. That would be one payment I would have to make after that first year. So even though the payments were broken up over 2 years, I would only halfway pay off the seller note in the first year, and then have to pay the full thing at the end of the first year. So this also has a 2-year non-compete. This is back when non-competes kind of meant something, not before they were federally meaning nothing. So also we have another severance package of some money for the employee, and then paid once the employee signs the employee non-compete and signs it. And then the funds were sent separately, actually sent them directly to the buyer because I didn't have the relationship or connections with the employee. And then the buyer was able to then pay the employee and move on. So here are the allocations or the breakdown of basically the assets or the price of everything that we had. We have our goodwill and we have our non-compete. We did put some sort of value on the non-compete. Most of it was on the goodwill of the business. There was no inventory to buy. There was no equipment to buy. We bought 0 computers, 0 nothing, because they were virtual. They didn't even have an office. So that's totally fine because they had the relationships and the connections. So, and also just as far as on the structure piece here, we put, just so you can know this, we did about 75% cash up front and about 25% seller carry. Now, the 75% cash up front I got from a hard money lender from the land business, because that's the business I was in. I had raised hundreds of thousands of dollars for the land business in my day. So I was able to get some money from him, and then the rest was seller financing, where then there was a second position note. So it was actually no, it wasn't second position, because this was separate, collateralized against something else. So at 75% cash, 25% seller carry note at the time. And every purchase I've done has had a certain amount of seller financing. It really depends on how, basically the law of price and terms in general. So you can have basically of price and terms, you can have for the buyer and the seller, you can have the seller's price and the buyer's terms, or you can have the buyer's price and the seller's terms. Oh, sorry about that. Sorry, this little diagram here. So if we have you have the seller, you have the buyer, you have the price, and you have the terms. You can see you could have the seller's price, the price the seller wants, which is usually the higher one. This diagram doesn't help that very much. But then it's going to be on the buyer's terms. Or you can have the buyer's price on then the seller's terms. So that's kind of how that works. They'll call the law, or not really a law, but the rule of price and terms. We kind of met in the middle for both of these. So that's kind of where we aimed in that sort of scenario. So other pieces to have here. This is just documents. This was all back work must be completed prior to the transaction date. Now this contract was made over a few months. I think it was over 2 months because we went back and forth on it a little bit, and then we also learned more about the business before we ended up finishing up the contract, which is something else I would recommend that you try to know as much as you can before the contract gets formalized the first time, because then it's more expensive to change it again. Ask me how I know that one. So the seller will, any funds paid to the seller for client work beginning August 1st will be sent on August 14th. The purchaser will hold back a certain amount of money in escrow to be paid to the seller on the 18th for making sure that it was essentially paid. So we took over this business middle of August. Why did we do it the middle of August? I can't remember. I would not recommend it. All my other purchases we've done at the first of the month. One of them was first of the year. So do not take over a business. Again, this is my first one, only a few months in. Do not take over a business at the middle of the month. There is no benefit to taking over the middle. But what this is basically saying is that for the money that the clients paid, so we have, we have August here, and we have the 1st, and then we have the 30th, or the 31st there. Okay? We took over on the 14th. There's money that was paid in on the 1st. They were going to hold that money for us till the 14th. To make sure they actually did that, we got it all. We were going to withhold a certain amount of the money. That's this one right up here. Okay, we were going to withhold a certain amount of money to the 18th. And then, once we reached the 18th, we were going to then send this money back. Then once we reached the 18th, we're going to send this money back to the seller to basically finish up everything. It's kind of a messy way to do it, which is again why I would recommend just buy it on the 1st, especially if they do the billing then. You just take all the billing from there and you move on with your life. Instead, we did this weird, they're giving the money to us, we're giving some money back to them. It was dumb, and it was also annoying during the actual deal as well. So again, wouldn't recommend it. A lot of things and what not to do on your first deal. So this is more talking about the retention clauses here, that we'll be, not retaining any employees. And then let's go down to, don't know what happened there. Down on the other page. Okay, this is part of the employee piece, basically saying that, we have to have the non-compete signed before we are, before basically willing to move forward. And she almost killed the deal. She got really close. This has to be done 3 days before. I think it was done 2 days before. But we just wanted the deal, so we wanted to move forward with this. This is a really important clause. This is our retention clause. And some people might break it out all the way to make it more easy to see instead of it being point, what is this, 0.26 letter F. So this goes to how many accounts the business had. If the business has, if we kept 85% of the accounts, 53 accounts in total are retained for the full year, there will be no deduction in the seller carry. So we'll pay the full amount of the seller carry. If retention falls to 75%, 47 accounts, the seller carry will be reduced by 50%. So we have, I could draw up here. So we have the seller carry amount, this whole loan amount right here. And if we're 85% plus, we're paying the full thing. If it goes to 75%, okay, here's the full seller carry amount. Then it is dropping, which is a really big drop, to 50% of the seller carry amount is owed. If it goes below that, so basically 74% and below, which it did with that one client actually, and we'll talk about that more later, then the seller carry loan totally goes away. Now again, the seller carry loan was only 25% of the entire purchase price. So that's how we basically figured out this one for us to be able to work all that together. Usually a 1 year, do the end of 1 year. Usually a 1 year Time frame is a good time because, especially with bookkeeping, we're looking at 12 different interactions with them. We're sending off reports, getting data, all that sort of stuff. And we did have a big drop off towards the beginning, which I talked about with that large client that we lost. And then we had some really gradual drop offs. And the only drop off we've had since then have been people going out of business. Because real estate is not easy right now. It's never easy, but it's especially not easy right now. So that's kind of how that all works. And then it would fall off here. So very important clause. Also for a seller. So sellers, you have to think about this too. A buyer is buying air. They're buying you saying to your clients, hey, go here. Go with Tim, go with Miriam. This is what they're doing. So what if they don't do that? Now, again, there is also performance clause, which I've had performance clauses in other contracts, which is where what if we do a terrible job at taking care of the clients, which is a totally legitimate concern on the other direction. So it's how do you balance out these two concerns on both sides? So this is the retention clause here, which is pretty common. All of my deals have had some form of a retention clause because I want to make sure that I actually get the clients at the end of the day. Again, I have good relationships with all my sellers, but part of that is that we understand what's going on here. They want to make sure that I'm taking care of their clients and some of their clients and their staff, if I'm taking on their staff, and I want to make sure that I am being paid to be able to pay them and then eventually make some money out of the end of this whole thing. So that's a retention clause there. So this is talking about here, point G, is talking about assistance for 3 months. The following transition, the seller will assist in any client or internal queries directed to the communication of the purchaser. Just so you know, as a buyer, so I bought a couple of accounting firms. One of them is a year-long transition. The last one, this one was pretty much snap of the fingers, we're done. Very, very quickly, just letting you know, a seller's motivation is going to drop off. It doesn't matter if it's 3 months. Their motivation is going to drop off a cliff during that time. They'll help you out, and she helped me out, which is great. But it is a tough one here. So just keep that in mind. Whatever is written here might not work out ultimately that way, or might not be as much as you think, and they might be thinking they're giving more support, the normal partnership type situation. They might be thinking they're giving more support than they wanted to, and you're thinking that you wanted more help, and they're not giving you as much help as you were hoping. But it's something you work out. You just talk about together. So, and then following the 3 months, if I were doing any more help, there was going to be an hourly rate, which is pretty normal, either a consulting agreement or an hourly rate, and then the seller will track the hours, and then basically say, hey, at the end of the month, I'm getting paid for these things. So that is going to be our retention clause, our assistant clause, and then our consulting clause that we have right in this messy paragraph right here. And this is just, because we're doing an asset sale, we're assuming no liabilities. We're not taking on the debts or the accounts payable. I don't know why it's doing that here, but yeah. So, and now let's go to the next page here. So this page we're going to get into the actual client lists and everything. So we're going to go over the closing really quick. So the closing, again, the 14th of August, middle of the month. Learn from my mistake. Never close in the middle of the month. I learned from my mistake the next time. So don't do that. Okay, then we have the non-compete, which these are just on the different schedules. Delivery of the promissory note. And then also, these are all the things that happened at the sale. The wire was transferred. And then everything kind of moved forward from there. So here is the asset list. This is what I bought, or what we bought, because you'll see Miriam's the only one who signed this thing. But, so the list of assets, which is the client list, excluded assets, the bill of sale. These things actually all go to the seller, to the seller is going to be obviously the promissory note, the bill of sale, all this stuff goes to both of us. But the non-compete is for us to hopefully have some protection against them not going after their clients. But then again, the non-compete's kind of null and void these days, but also the retention clause kind of keeps it null and void, because if they competed with me and took clients, then I have the retention clause to lower how much I owe them. So kind of all works out there. This is the client list. Obviously, very anonymized right here. You'll see something I want to point out. 28, and then all the way A through E. Real estate, so we had lots of different entities. Okay? If we look at like 56 here, okay, and then everything down here, all those different entities were into that one. So having the retention clause based on the number of accounts, when we were counting accounts, you know, A, B, C, D, and all these different numbers, you know, we didn't have to lose very many key people to make it kind of a big problem. So the paperwork walkthrough continuing here. This is the list of excluded stuff. Essentially, accounts payable and technically accounts receivable was also prior to closing. And then just the corporate books, which we didn't care about that. That didn't matter. This is the asset sale agreement. My word. Bill of sale, and then the non-compete clause right here, which again, I think in 24 or something, 25, non-competes pretty much went away, but still, it's just nice to have it written down. The big one I actually cared about was going to be the non-solicitation covenant right here. I think that might hold a little more weight than actually the non-compete at the end of the day. Also, that basically we'll be keeping any manner, either directly information, basically this information private and not for the benefit, which is why I've anonymized everything here. So, fun thing happened here, the updated Schedule A, which is the list of clients. So we have different font format here. So the amendment that happened August 7th, pretty dang close, past actually August 1st. We were 7 days from closing when we found this out. We had a big amendment because we found out that there were several clients on their list that weren't actually on their list. So the list went from 58, see we have 31 here, went from 58 to 51 was what their list went from. And that was a pretty big move. So we changed up the actual retention, or the actual retention clause. Sorry about that. Non-compete. So we actually, pull up update Schedule A. So we actually changed the whole retention clause here. So, because obviously we went from 58 clients to, or 58 to 51, that's going to change our numbers. And actually it was much higher than 58. So now it went from, down here you can see the old numbers, big takeaways 53, 47, those are the two big numbers of accounts. Now we went to 43 at 85% and 38 at 75%. So if we went below 38 accounts in total, seller financing note goes away. Also, there is, we dug in more. Again, this happened 7 days before the closing. Outstanding back work, which in the previous clause was supposed to be done beforehand, but it wasn't. Therefore, we lowered the purchase price a certain amount because that was going to be the work we were going to have to do. So we gave them a bid for how much it would cost us to do it, and they decided to have us do it versus them do it, which is fine. So, and then also we added in any referral fees after the transaction or transition here, which we did. I think they referred to as 4 or 5 clients afterwards, and we just paid them a referral fee. The referrals did not affect the retention clauses because the retention clauses were actually for the current, for the client list that we were actually buying at the time, not for future referrals. So important pieces here. The escrows, having those holdbacks, Again, dumb for buying in the middle of the month, but we had them for protection. The actual holdbacks and for the retention clauses that we could, or the retention thresholds is right here, that was really big to make sure that we were safe, and that was really important because we wouldn't have had the amount of revenue we needed to actually pay for the whole business if we wouldn't have had that retention clause in there. And then the back work clause, which we added in after the fact, once we actually dug in deeper and saw there was a lot of back work that still needed to be done. So also we had, as you saw in there, the transition assistance. The seller supported post-close, which she did a good job. She did support us and give us some information, especially in that first month, then died off more the second month, and then the third month, we didn't need her anymore. We were pretty much good to go. So, and the promissory note was really important to have that separate with the retention clause because, again, with us losing 25% of the clients or 26% of the clients, we wouldn't have been able to pay the whole thing. It would have been very, 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 very tight from a cash flow perspective, having the reduction number of clients. Again, because it's that balance between the buyer and the seller. As a seller, you want to get paid, but the buyer has to get enough money to actually pay you, or else it's not going to work. So here's the promissory note. As you'll see here, it is just my partner's name. Again, we do not remember why exactly, but it's fine. 2-year promissory note for a certain amount and 12 cents. Both me and the seller are real estate people, so we're very familiar with these sort of things. Basic promissory note, again, we mentioned it before, the 2 years, 4% annum. Pretty basic. Interest accrues on the 1st of August, first payments on the 1st of September. Okay. And then the balloon payment due 2024 of August, which we never got to because the retention clause is actually after 1 month went away. So that is the promissory note. Post-closed, we announced the close via text email only. Actually, that was a mistake, and the email was sent off without, we were using a mail merge, so we were having all the fill-ins, and the email was sent off without the fill-ins the first time, and it was just dear client in brackets and a lot of other stuff, so that was fun. But it was sent off via email. I did this differently in other ones in the future. There were no pictures. There was very little story. It was very much just matter of fact. And again, you're buying relationships. You're buying habits of the client. So, would really recommend not doing that. Again, learned a lot here. I didn't really realize change was negative, and the clients wanted to meet us, which is another big mistake we didn't make in the first one. We didn't have a Calendly link or anything easy for the clients to be able to reach out. We just emailed them and said, here you go. Basically, here's the new email for your new contact, but no like phone numbers and all that sort of stuff. So because of that, we did roughly 30 plus, which I know there was 50 clients on there. We talked to every client. We talked to every relationship, every person, because as we learned with those 50 some odd clients, one person I think was 10 of those, and they were one of them that left. So pretty much knocked us down. Then they had a few friends, and then one other person didn't want to stay, so it was pretty much done. So we did this over 2 weeks. They were an hour apiece. A lot of basically reassurances, expectation settings, basically onboarding a whole bunch of clients all at once, which is what a tuck-in is. It is a lot of work. The post-close, we learned bookkeeping isn't necessarily bookkeeping. For a lot of theirs, they didn't end up sending reports, which is fine. Totally fine with that. But it's something that we do. And there were some backwork things that were issues. There were just some issues in the books that we didn't realize. And so also, there were several clients that had weekly or monthly meetings that we didn't really realize or understand how in-depth those were going to be and the client's expectation of those until we got into them. So that was definitely tough. And we inherited expectations we didn't fully see ahead of time, which basically where I'm at now when I look for an acquisition, even someone else telling you, yes, we send them financials, we send them reports, we send them profit and loss. If you can get, as far as if you're a buyer, if you can get from the seller the actual documents, like go back a month, hey, send me all the documents you sent all your clients. So I can just see make sure we're talking the same language, because even though we're talking accounting and we're talking bookkeeping, people's definition of bookkeeping and people's definition of different accounting services vary wildly. I mean, that's one of the benefits of being accounting. It's a very black box industry, but it is crazy how much they vary. So, again, that larger client who had about 10 accounts left, he wanted to take his bookkeeping in-house, which is fine. We didn't ever talk to him himself. We only talked to his assistants. And then 2 of his also partners left, and we think we had 1 or 2 other people leave, so that pretty much did for the retention clause there. So the retention clause saved our butt in this case. And it was a bummer. And the seller reached out to this client, and the client didn't want anything to do with it. So it is what it is. Everyone makes their own decisions. And again, relationships. So afterwards, we actually, it was less than 75%. It was literally like 72% client retention at 1 year. And then losses, mainly model differences, different expectations. They had a client that was really shady that we ended up letting go because he wasn't being nice to his partner and wanting us to hide stuff, so that's not good. But some clients referred us to additional clients, and then also about 25% became tax clients because that seller, he only offered bookkeeping. We offered bookkeeping and tax services, so then we were able to do those as well. For the cross-sell and then be able to refer to increase our profitability. So it is now January, so we're like almost 2.5 years, close to that. We're roughly 65%, mainly from some closing. We have raised some prices this year, and we did have 2 more leave because of price raises, but they were really, really low and really not profitable, so I'm fine with that because overall price raise still in the entire book was well worth it. But several clients have brought us their other businesses and some of their friends, which has been great. Still have a good relationship with the seller, see each other on Facebook, comment, like, do that fun stuff. And I've actually used the seller. He's actually been a referral source, a reference for me for one of my other acquisitions later. They wanted to say, hey, I'd like to talk to one of your previous sellers. Totally realistic, totally good idea. So I connected them, which I'd be willing to do with any of my sellers. And they were able to talk about what the process was. After the sale, the seller, he finished moving to a new state. They're on the East Coast, got back in real estate, and they're having a good time. They're great. They're moving on with their lives, and he's in real estate rock and rolling. So, closing takeaways. The one thing I wish I would have done when we first bought the business is have a warmer intro sequence, okay, with the client, but also as far as with the seller, we did have warm intros, and then we ended with the contracts. In a tuck-in, and even in a bolt-on too, you're marketing relationships, not just the data. Very, very important, especially when we're moving 40 clients in a month. That first month or 2 was tough. Doubling the size, we did not bring on any new employees at the time, which was also rough, but we didn't have the cash for it at the time. Our cash position in the business was far different. So defining bookkeeping and writing is really helpful. If you guys can actually understand or be on the same page with what that is, that'd be great. The holdbacks are super important. And in most of them, I don't have to, most of the purchases I've done, I haven't had to really do those, but this one definitely did. It was a seatbelt for us. And then having it seller financing made it so we could make the deal happen at the price the seller wanted to. And then we did lose clients. That will happen, and that does hurt. Also for the seller, it hurts because they've had that client for X amount of years or X amount of months, and we're adding change. They run the business differently than we run the business in certain ways. It could just be a change just in the fact that they just don't want to go through a change period, or they might want to take the bookkeeping in-house. So that's one thing as a seller to understand. There will be a certain amount of clients that you will lose during this process, but that's just how it is, unfortunately. Clients leave for all sorts of reasons, and an acquisition is sometimes a reason for clients to leave. Even though those other ones who were very happy that they stayed, some will want to leave. Okay, transitions are hard. On the YouTube world, they are business buying, super sexy, you buy a business, and that's all people talk about. They don't talk about running the business afterwards or doing the transition of one of my other acquisitions, 200 tax clients. So that's something that it's tough. It's not easy. It's worth it. It's definitely worth it, but it's not easy in any way, shape, or form. Okay, questions from the audience here. I have a question from Jason. How do you manage multiple locations? We currently have 2 locations. Okay. And in each one of those locations, we have essentially our structure. So we have what we call our office manager. Up at the top level here, then we have a few different client managers. And then we have bookkeepers underneath those client managers and also admin. Okay. We use a program right now for our project management system called Canopy. And so we're managing multiple locations by the office manager has a checklist that she then shares pieces of it. She breaks it into pieces. That's her multi-hundred task list to do every month. She breaks it into pieces to the client managers, who then break it into pieces to the bookkeepers. So therefore, we're able to see as the ownership. We're able to talk to the office manager, see where they need help, see if they need more staff. We're able to talk to the office manager and to be able to get basically a report for what's going on. Managing multiple locations requires you to systemize a lot more. You can't have things as customized because there's just so many more things. Now again, this is still something we're massively learning. There's still a lot that we have to grow in this, and we've been doing this 2 locations. In March it'll be a year since we bought our second location. But this is kind of how we're doing right now at a very high level, is we have a structure. The client managers know their job, the bookkeepers know their job, the office manager knows their job, and then we make it clear by dividing out their job under, anywhere from 10 to 25 checklist items per week per person, as far as on the very base level for each individual person there. Rochelle, who's a bookkeeping friend of mine, would a bookkeeping firm benefit from hiring a CPA seasonally or year-round? In this regard, she is mainly talking about would it benefit a bookkeeping firm to start taking on tax? And yes and no. If you're getting a lot of referrals from CPAs because you don't do tax and they're not concerned about you taking their tax clients, then probably not. If you aren't getting many, then absolutely. Tax, we've had roughly a 25% take up from any time we've bought a business that doesn't have tax. Actually, this is the only time we bought one that didn't have any tax. About 25% of them end up turning into also then tax clients, which really helps your revenue. Also, we have a lot of businesses that come to us just for tax, and then we end up doing bookkeeping services for them later. So it depends, because tax is a completely different business. In bookkeeping, if we have just January, okay, then July, and basically December here, we have those 3 months. We're going to have our bookkeeping, okay, the flow a little bit higher in January, and then pretty much like this, the workflow a little bit up in December. That's in general the demand curve or the workload curve of bookkeeping. Tax is very different. Tax will start in July when it's nice and low. Now again, I'm going to assume only we're talking about personals and businesses, not 990s. We do about 450 to 500 tax returns a year. We do personal tax returns. We do business tax returns, and then we also do 990s, roughly almost 100 990s. So we're busy all year. Taxes are, we have 6 tax deadlines a year, and so taxes every month for us. But for a normal one, we'll just call it for business and personal. Your workflow goes like this, and then it goes up a little more, and then up, and then crazy high, and then it drops way back down here, obviously after in May time. Okay, so what you just have to keep in mind, and now again October is a little bit of a bump too, depends how many extensions you have, but what you have to keep in mind for yourself as a business owner who just does bookkeeping is, are you willing to deal with either Actually, I'm going to make this green a little lower here, because when it's dead, it can be really dead. Are you willing to deal with these different demand curves? Because if you're taking your bookkeeping staff to help out in your busy seasons, which I've done before, ask me how I know, your bookkeeping will suffer. Your bookkeeping will get worse. Reports will get out late. Things won't get done. It sucks. Okay. If you want to staff enough to have someone all year, paying them during this time of year, during the summer, sucks. So if you can get one part-time, that's the best case scenario. That'd be my recommendation. If you can go part-time versus full-time, that's also hard to get as well, or especially part-time seasonal. That'd be kind of the recommendation. If you do that, that'd be good, because you're going to have these 2 times, and really also in October, that are going to be really kind of a challenge and painful. Or you can just do nonprofits, and then you have also May deadlines, and you also have November deadlines. You have March, April, May deadlines for business, personal, nonprofit, and then you have September, October, November deadlines again for business, personal, and nonprofit. So you just do that and just do tax all the time. So can it be beneficial? Yes. If you're getting a lot of referrals, it might not be, but that is kind of my answer to that one. My name is Tim with Krause Accounting Group. Again, if you're looking to potentially sell your accounting firm, please reach out. I hope you enjoyed this video. Have a great day. Thank you. Bye.